this is an audience that is very well experienced in terms of how to manage money. Some of the concerns that they have are quite far removed from what the majority of investors have. So just going back to the point that you made earlier about the importance of liquidity, what base effect really means in terms of planning, and of course, asset allocation. What are some of the key findings you've had? Because there seem to be attitudes, generational attitudes as well, that perhaps one should revisit when it comes to asset allocation.
Wonderful, Fatima. I think you have touched upon the most important point, because this is like 80%. If you get this right, then it's seldom that a large portion would be missed. So asset allocation as it is defined is allocating your money in different assets. Okay? Firstly, if you have to do asset allocation, you have to understand what are the assets which are not distractions, which are actually right assets. There are two growth assets, equity and real estate are the only two assets which have shown capability to beat inflation over long periods of time. Everything else is a distraction. Two growth assets, two assets which bring stability to your money, which is gold and deposits. Two growth assets, two safe assets, a combination of that, depending on what risk I wish to take, is called asset allocation. Now that I've clarified that there are only four assets which I as an investor or I as an advisor would look at, and the rest of them I would ignore, the life becomes a little more simpler. But the step two, which is I think the mistake which most people do, in my experience of having met so many people, if you ask me what has been the learning on this topic, it is that asset allocation, they do it for a portion of the component, not for their entire balance sheet. Asset allocation can only be done if you put every rupee you have on a piece of Excel sheet or a piece of paper or an Excel sheet. So point I'm making is asset allocation, people take a portion of their assets and say I'm doing asset allocation. Right? They leave their real estate aside. Asset allocation should be on your entire balance sheet. If you see a company's balance sheet, all, including furniture, will be there, depreciated value of furniture. Except the house or offices you consume, everything else is a part of your balance sheet. The house I live in is not a part of my balance sheet. So most people, 90% of the people I have met, are not drawing up their balance sheet correctly, right? Bad input will result in bad output. So get your balance sheet in order and then go on to the process of asset allocation. Then what is the best asset allocation for the next 4-5 years, looking at where we contemporary situation, what is the right asset allocation? At least seemingly right, in my opinion. Right, only time will tell. Real estate, we have been negative for the last 4-5 years. Of course, at that point in time, it would result in large debates with people saying, how can you
Not so much anymore.
Not so much. People acknowledge that real estate is in trouble. Of course, real estate, the entire country is real estate. I'm speaking of residential metro real estate largely, which is what most of our friends and clients end up owning. So that will continue to go through a big struggle, in our opinion, and data says so. Of course, our love towards this asset is so much that it becomes difficult for us to believe that this can go through. So if you look at only data and not have the personal bias as we Indians do, so real estate, low. I would ideally not have any investable real estate, which is what has been the recommendation for the last 4-5 years, and continue so. Equity can be 60-65% and debt should be a 35% at an asset allocation.
So this is what we're saying. Now, what I'm actually building up to is, and this is before we really get down to the meat of this conversation, which is going to be about risk management. I want you to talk to me a little bit about liquid wealth creation, because that's an essential point, and it's sort of an inflection point from what you were saying. What does that really mean in this day and age?
Liquidity, right?
Yeah.
Yes, I think you, Fatima, has brought the right point on your behalf. Liquidity is the most important risk which we end up neglecting, right? See, today's biggest reason why such a sharp fall has come is because of liquidity of a bond of DHFL. Think about it. So liquidity is so powerful that the asset's value is never discovered. I might have a house, but if I can't sell it for 2 years, it's worth nothing. Okay, I was reading up some, I think it was an Oxford report, which says wealth is only that portion of your money which is portable. I met a gentleman, he says, I've got 100 acres in Kharghar, which is next to Mumbai. He says that's worth 700 crores. But he has 12 crores liquid. So his net worth could be 700 crores, but his wealth is only 12. Right? So wealth is that portion of your money which you can take and access on a click of button. Let's respect liquidity, because being not in a very dynamic environment, if you can't make changes, right? So I think liquidity is important. Now if I went to objective 2, I'll give you one example which is very dear to my heart, is because I lost a 32-year-old cousin to cancer a couple of years back, and his dad was a very wealthy man, seemingly, but his monies were locked up. When his son has been diagnosed with cancer, he's running helter-skelter to sell a house so that he can send his son to treatment abroad. So what was the point living a life thinking that you have money when you want to spend the maximum time when there's little? So then I think that your purpose of money is lost. So liquidity needs to be given paramount importance. Portfolio designs which have 60-70% in real estate actually are counterintuitive to this point. And Fatima brings this very valid point that you have to give importance to something which is liquidity, and be it in financial instrument or non-financial instruments, liquidity is paramount.
And we're going to visit how that can actually happen. But what I'm building up towards here is that the word risk, and I think I've seen you say this before, we seem to not really, some of us have trouble digesting risk as an English word versus a concept of mathematics. And I think that's a really central point that you make. So number one, if you could really explain what risk means, because we all understand, our portfolio managers also talk about standard deviation and the technicals of it, but what are the key takeaways when it comes to risk, as well as what is finally acceptable and not acceptable risk for HNIs and ultra high net worths?
Yes, Fatima. Risk, of course, if I look at different markets, like Delhi and Bombay, I think this is a relevant topic for Chennai, because if I have to plot people, there is some degree of risk aversion down in South. And I think it's a relevant point to bring up, Fatima. Risk, ideally, is a mathematical word. But in most of our conversations with our advisors, we use only English: aggressive, conservative, moderate. But if I discuss return and said this is an aggressive return, the next obvious question is, tell me your expectation in number. But that doesn't happen in mathematics when it comes to risk. But risk, fortunately, in treasury is a very deep subject. Every day a treasury manager gets an Excel sheet with what risks mathematically are defined for that particular day. In statistics, there are 4-5 measures of risk. Unfortunately, in our industry, we have made it overly complex. It's actually very simple. And we can discuss one risk, which I am sure most of us will be able to relate to. The measurement is called value at risk. See, for a lay person or an investor who's not doing this for a living, he wants to know, when worst happens, what happens to my money? If I'm able to get a number to that, that's my definition to risk. This is what most of the people are able to relate to.
Sure.
So if I said, if 2008, which was a bad year, if that happens with twice the magnitude, what happens to my money? If that number is told to you, out of my 10 crore, 1 crore goes away, then the value at risk is 1 crore. Is that acceptable? If it is not acceptable, change your strategy. If it is acceptable, implement that strategy. But it has to be that number which is called value at risk. So in treasury, value at risk is computed on a daily basis, which defines the worst situation and sees what happens to my portfolio in the worst situation. So as an investor, your takeaway on this topic could be, if not standard deviation, value at risk, has that been currently defined by your advisor? If it is not, that means risk is still a nomenclature of English and not mathematics. Of course, there are 3 other which are simple enough, but I think for the lack of time, I would restrict it to value at risk.
But what I want to do is just also contextualize recent news events that have taken place as well. I mean, look at what we saw with an ILFNS. I mean, I think that's a good example of, we were talking about credit risk earlier. And also, if you could just go back to what we were seeing, which was a big market fall that we saw. Of course, we saw the market recover, but these days will come, they will happen. So given this scenario, given what you're saying about risk and the kind of mathematical considerations we should have in it, how would you contextualize what's happening?
Wonderful. I think, Fatima, you're highlighting other risks.
Yeah.
Now, what I just told you was market risk,
yeah.
price risk. Right? We spoke about liquidity risk, not being able to access your asset at the price which you think it is liquidity risk. There is one more risk which you touched upon, was credit risk. Okay, we will get to that, and let me define that. And this credit risk is nothing but, I lend to a bank, for example, in the form of an FD, and that goes bankrupt. So I loan money to my friend, and my friend goes bankrupt. That phenomena is called credit risk. Lend to person and he goes bankrupt and insolvent. This is the biggest risk known to mankind, because market risk corrects itself automatically. Market has fallen today, 1 year later it will come back. At least 2 years later it will come back. But credit risk never corrects with time. You have lent to a friend, he's gone away. Give him 50 years, he's not going to bring back the money in most situations. So credit risk is the biggest risk in mankind's definition, and most of us take it very, very easily. Now, when you say credit risk, people generally tell you that I have put money in a AAA rated company. Rating is the measure of credit risk currently available. Okay, so DHFL today, okay, is a AAA rated company. Ratings is what we look at when we invest, saying that is this a person safe to lend to? Now that we have 30 years of history in India, which couldn't have been said in the 1990s, today you can say that there's so much data to find out whether credit risk has been well measured by these rating companies. And you would be surprised that they've done a shoddy job. Okay? Why am I concluding? Because you, like ILFS, which Fatima mentioned, was downgraded on 8th September, not one notch, 16 notches in a single day. So 16 notches in a single day means till yesterday I was thinking it's great. Today I think that it has fallen 16 points or 16 levels lower. That means that you are being more reactive than proactive when people are taking decisions of their hard-earned money on the biggest risk possible, depending on your rating. And then we did an analysis, 20 companies which went belly up in India. What was their rating 3 years back? And you'd be surprised to know most of them were AAA. So if I can't predict the default possibility using credit risk, using ratings, is there another method? Finance actually has another method, which is what we end up using in treasury. If rating is not good, I can't only create a problem, but I also have to, in finance, there has to be a solution. Might sound technical, but yeah, if you have a good advisor, he will do this for you, which is called Z-score. You should not ever look at rating and put your money, in my opinion, because we have been bitten, and if you don't learn from our mistakes, that's very ironical. So we have been bitten several times by looking at ratings and invested. Okay, and today is a very good day to say it. A AAA rated company, and I was speaking to somebody today, a journalist, and he or she predicts that in the next 10 days, there could be a default on that. On a commercial paper. So that's like a AAA rated company. So what do I use as an alternative to entrust my hard-earned money is Altman Z-score, it's called. Okay, that's sounds more technical, but it's very simple. It's a formula which you can get information about, and that's where you have an advisor. No? As an HNI, a group, you are fortunate that you can afford an advisor, but afford the right one so that who can do this computation. Altman Z-score.
Can you briefly tell us a little bit about it? I mean,
it is a formula which was discovered several years back, and that gives you a second decimal probability of a company going bankrupt. Let me explain with an illustration. a few years back, a company called Amtech Auto was in trouble. Okay, its rating was AA, 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 AA for 4 consecutive years, and suddenly it went into default. 4 consecutive years, AA, 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 no change in it, suddenly goes to default. Now, the other method which I just introduced to you, if you already didn't know of it, Altman Z-score for that company, anything more than 2.5 for a manufacturing company is a good number. So it was 2.89, it was 1.32, it was 0.38, then it became minus 1.24.
Sure.
Altman Z-score gradually kept going down, but rating was static. So if I looked at rating, then just a day before it went default, I would have thought it is AA. But if I looked at Altman Z-score, I would have very easily concluded that the balance sheet is going to be heading towards some trouble.
If I was to just go back to a question that one sees resonating across investors, what is really the best way of reducing the pain that you can face in terms of short-term volatility? Because we all know that risk and volatility go hand in hand together with opportunity. But how do you sort of make it less painful in the short run?
Yes. If you look at investing, it is governed by 3 emotions. So if it's going to be painful because of emotions, right? So you have fear and greed, which are the 2 popular emotions.
Yeah.
But the third one, which doesn't get touched upon so much, it is the fear of missing out. My neighbor says, I did this. FOMO. And then you feel FOMO, or that's the youngsters lingo.
Yeah, yeah.
So there are 3 emotions. So pain is one thing. In the short term, I'll have to either practice to live with it, okay, or I have to use methods of treasury which have mathematical solutions for it. Now let me tell you, one is you have to take the risk, acclimatize yourself to risk, because data clearly proves that not taking the risk is the risk in the long run. Okay, if you went to a bank in 1990, and I'll break this down into 3, you went to a bank in 1990, the same bank, and you said, HDFC Bank, make a fixed deposit for me. The money 1 crore would have become 9-10 crores. If you went to the same bank and said, put half my money in equity, half my money in debt, you would be left with 125 crores. Okay, how much did I miss as an opportunity? 115. You might still not want to put equity, but look at the data and then take the decision. But 1 crore becoming 10, and even if you said half and half, same bank, you said that why don't you buy a HDFC equity fund? It was launched 3 years later, but yeah, if you put it in Sensex and after 3 years moved it to, 3-4 years moved it to HDFC equity, you would have been left with 250 crores on equity, 10 crores on debt, you would have been 125 crores. So the person who didn't do this doesn't first know that he has missed out 115 crores.
Okay.
So that's point 1. So taking the risk, getting adjusted to the new weather, because Chennai is a humid weather. You're used to, right? I was sweating, right? When my colleagues were standing outside, they were not sweating because they're acclimatized to the humidity maybe. So you have to get adjusted to the nature of the beast, which is equity, as long as you have the time on your favor. Second is, if you still can't, because you've lived a way of life for such long periods that you can't change your direction, then use a method called LEAP, LEAPS, which is available in India for 10 big years.
Which is something that's existed, but for some reason there seems to be some kind of a gap in terms of how well we're seeing it represented in portfolios. What's going on there? I mean, is it, sorry to say, but is it a commission-based issue, or what exactly is LEAP? How's it all worked so far?
Correct. I think LEAP, to define, and then of course, like you said, I agree with you completely, that if I was earning a lot of money as an advisor on a LEAP, it is likely that in 10 years all of us would know it, because everybody at a point in time will need this. May not be today, may not be tomorrow, at a point in time you will need this. If you are an investor who is pursuing 15%, you will have to keep this in your armory to use it. So what is this? LEAP is nothing but, and if I drop an analogy to make things simple, is like an insurance policy on National Stock Exchange, which protects your portfolio against falls in Nifty. For example, if I put 100 rupees in a large cap fund or in equity and alongside bought myself a leap, if the market goes down to zero, NSE becomes my counterpart to give me a compensation. Just like I buy myself a car and a car insurance along with, if I go crash my car and if there's a 4 lakh rupee expense, maybe the insurance company, if it's a very well-rounded policy, will give me back my 4 lakhs. Similarly, there is a leap available. It was launched, it was introduced in India by a circular of NSE on 28th of February 2008, much before the crash of 2008. But till date, when I speak to investors, they say, I've not heard of it. That is because treasury management is using all finance and wealth management is happening on the basis of commission.
Okay. So there are existing mechanisms. When it comes to risk, we should really be looking at this as a mathematical issue, and within that there are of course equations that one can very much look out for. Let's talk about structured products, because you've been a pioneer on that front. First of all, how have you seen the environment change and structured products actually becoming more relevant to portfolios, the kind of demands you see from investors? And also, let's not forget that you yourself are a major investor yourself, which is what makes this so much more fun than talking to just someone who's managing the money. What are your key observations when it comes to those?
Structured product, in my opinion, we 6 years back banned almost 8-10 products of wealth management for our clients, because we thought that they were experimental in nature. 2 products and a leap risk management method can create one portfolio which can take care of most people's need. One is a mutual fund, the other is a structured product. You don't need a third product, in our opinion, and data says so. That's why we have banned several high commission products like PE funds, AIFs, PMSs. PMSs are still an acceptable platform. So point one, Fatima, I would like to say that I'm just trying to drop a context of how do you use a structured product. You have 2 products. One is your plan A, the other is your plan B. When we go to a restaurant on a weekend, we have a plan A and plan B. Right? If I don't get a reservation here, what will be my fallback option upon? So ask ourselves this question, we have to ask ourselves, does investment need a plan B? If it so does, what is your plan B? In my portfolio, I might put 60% of my money in structures, because I've been doing this for the last 10-12 years and I've seen so many products mature, maybe 1,000. Right? But we very strongly recommend to our clients that 30%, 35% of your money should be in structured products. 65% should be in mutual funds, and this is a good enough portfolio as long as your return expectations are not 20-25 and 15 quenches your thirst for return. Structured product gives you a return which is a capped return. You get only 16-17% per year, which is good return, even if the market delivers 5% a year. But the downside of it, or the disadvantage of it, is you will never make more than 16-17%.
But that goes back to the whole idea of objective, right?
Correct.
This is about setting your goals, right? I mean, at the end of the day, I think the reason why I also started with that was because I would say that one of the biggest problems one has seen in portfolios where you have a lot of experience that's handling it is there seems to be some confusion in terms of objective. So going back to the percentages that people should be expecting, is that a varied conversation, or should there be a particular range that you're looking at, and then you can do what you want with it? And secondly, I also want to ask you, while we're talking about structured products, what is the key observation that we're looking at when it comes to equity and debt? What are the sort of different points there?
Of course, so there is some degree of individuality each of them have, right? So that has to be superimposed. My risk appetite, my behavioral pattern, all that has to be superimposed on a strategy. So I was giving you a thumb rule for long-term money, 10-15-year money. One, again, the problem what happens is sometimes I look at my age and make an investment, but most HNIs don't end up spending their money. So it might be their grandchildren's money. It might have 20 years more to invest. If you're going to spend all your money on before you in your retirement, then it has to be commensurate to my risk appetite. Because your grandchild is not going to ask you, in this budget, was I 30% in equity or 40% 25 years from now? Right? So if the money belongs, it's in your custody, you hold it. Are you the owner? You have earned it, you are driving the car, but you might someday hand it over. So long-term wealth is what the thumb rule is. You have equity and debt, which is your first decision, asset allocation. Second is the product allocation. So if you remove the clutter, and there is enough data to say most of these exotic products have turned my money into experimental money. And after 10 years, so you have to be very careful if you're buying anything beyond these two, in our opinion. Of course, I'm not giving you the stat of why so. Private equity funds, when I pulled out the return in India, after finishing 10 years of private equity funds in India, all the presentations read 20 to 25% expectation, average return was 6.2%, right? After that, if I still, and the simplest product in the same period made 17%. I compromised my liquidity for 10 years. I got 6.2%, that too pre-tax, and I took risks which were exorbitantly high. And if I still as an advisor recommend it to you, either I'm not looking at the data, or the 10% commission which I get on my table is luring me to still promote them. Either way, I'm not a good advisor, right? If I don't look at data. So the point is, if you're buying anything beyond these two, there has to be enough strong reason why you're contemplating. Then coming back to product allocation, 60-65% in mutual funds and 35% in structures. And in structures, there are conservative and aggressive. We at least classify debt structures and equity structures, so half and half. In the structures also, you have something which is aggressive. Like the one which I mentioned says you make 17% if Nifty delivers 5% a year. You also have another which says you will make 13% if Nifty delivered 1% a year. So this brings in a lot of predictability, right? So this is the product allocation we recommend. Then coming to the generational bit, when you're looking at generational bit at this stage, I would like to highlight one thing which most people miss out is that one person in the family knows the strategy. Nobody else knows. So if I don't train my son on the strategy, the money will not be managed well. So it's not just about giving money to a person. You have to train them over a few years on what you're doing and what is the context of what you're doing. So I have seen people have given a land in Gurgaon to a person who's an NRI in US.
So it's completely irrelevant for them, and given the liquidity factor as well.
Right, so you have to make sure that you train the next gen. Once you have put a strategy in place, you will have to give a context to the person who will take it over from you. And so 1 meeting, 2 meetings, 100 meetings, my wife will learn the art of doing what I'm doing, at least to the extent of 70-80%.
Just as we close this conversation, because it's always very tempting, especially when you have ultra high net worth and net worth portfolios, because here's an audience that is exposed to excellence in terms of planning. You of course have someone like Feroze also, who's taking us through the sort of nuts and bolts in terms of relooking at portfolios. One of the big themes has been, about tomorrow's themes today. I mean, being a private client is really about also, besides a certain amount of assets you give for management, it's also really about being ahead of the curve. There's been a lot of talk about, the future in terms of sectors and how much one should be looking at perhaps digital companies, AI, that sort of exposure going forward. What are some of the observations you're seeing now when it comes to, because this ties into to future investments as well. So what can you tell us about what's happening?
Sure. I think like you rightly said, that if I'm an HNI, I would expect my advisor to do some degree of crystal ball gazing and tell me the trend of the future so that I can be ahead of the curve. Otherwise, access to an advisor is not relevant if I can't.
Advisor versus trader. I mean, there's a big distinction there.
Absolutely. So there, what happens is people do this mistake of being an investor, but they like to understand the direction of the market. If you got this clear, that first decision is, am I a trader or an investor? If I'm a trader, I know I need the direction of the market. If I'm an investor, I need a trend of the market. Or trend, what are the trends which will emerge? Trends, fortunately, are far easy to understand and very easy to extrapolate. So let me give you an illustration. Okay, if I'm a trader, I would want to know what's going to happen before the election and what's the trend of the market. And I will analyze the last 3 general elections, last 4 general elections, and say before the general elections, 3 out of the 4 times, market rallied 30%. Okay, so trader is trying to find out the direction of the next 7-8 months, which are crucial. If I'm an investor, I will look at trend. Now let's look at trend. if I give you an example, you should not look at trends in product. You should look at trends in assets. If you're trying to look at trends in products, I think you will be disappointed. So trend in assets. See, today, if I give you a trend, okay, clearly emerging, equity in India is last 10 years has been propelled by Firangi money, foreigner money. Next 10 years is going to be propelled by Indian lower strata money, not even the rich people. It's going to be powered by the poor people of India. Now, why do I say so? Three things. Today, the poor man putting 3,000 rupees or 2,000 rupees a month aggregates to 7,700 crores a month. Okay, 7,700 crores a month is coming into equity mutual funds, not by tapping into HNIs, by using the power of our demographics of such a large population. That will, and that is also with only 1.5% of Indian population.
Okay.
Okay, globally, US has upwards of 50% of US population participating in mutual funds. India has only 1.5%. And SEBI has in effect decided to spend 10,000 crores in the next 10 years on investor education. 10,000 crores. If that kind of money is going to be spent, will at least 10% of India invest? If it so does, to give you a context of 7,700 crores in a month which is coming today, the entire FII outflow for this year from equity is 7,000 crores.
Okay.
So one FII outflow of 7-8 months is equal to or lower than 1 month inflow without tapping the Indian HNI, right? So the trend is, and this large portion of this money as per regulation will go into 250 stocks, okay, which is an anomaly to my mind. You should not concentrate such amount of money in 250 companies in a large country like us. But SEBI circular automatically says that this money, 60-70% of the beneficiary of this money would be 250 companies. Now, will this kind of supply, if it is chasing, this kind of demand is chasing a very limited supply, prices will have some degree of stability and growth over 10 years. So that's a trend.
How worried should we be about markets moving in leaps and bounds over very few stocks? How should we be looking at that as investors?
So that, like we technically in our nomenclature call it as polarization.
Exactly.
Right?
Yeah.
So only few companies are running. That is actually the state of affairs as we speak. Only 5-6 companies have taken the market up. The rest of them are all in doldrums. Market is up, but my portfolio is down. Looks so counterintuitive. So polarization, if data has to be seen and history has to be believed, regularizes itself. Okay. That's the good part. Okay. Now, polarization always gets regularized. That's called mean reversion. Polarization is not a phenomena which can sustain for 5-7 years. Now look at 2017. Okay, 2017, large caps did 28%, mid caps did 37 or 38, small caps did 60. Right? If I am looking at 2017, what does it look? Oh my God, mid caps and small caps have really left the large caps behind.
Yeah.
So that's called polarization at segment level. Next 1 year, 2018, is just the opposite. Mid caps and small caps have got rogered and large cap is doing well. So that is called the reversion of polarization.
Okay.
But what happens is quite a few people who invest using the fear of missing out, invest at the wrong time.
And you talked about that earlier.
Correct, so that's the point.
All right. Well, I've had the pleasure of having Feroze to myself, as you can see. It's been wonderful talking to you right here, because I think the good thing about this discussion is that we've talked about the overall way to, I guess, approach a portfolio given the kind of concerns one has. And it's very comforting to also know that there's a lot of mathematical calculation that can be put in to really understand your objectives. A lot of uncertainty is really actually what we have in our minds, but it doesn't really actually, it can be completely mitigated. This is now my opportunity for the audience to actually interact with Feroze and ask him any questions you have.
Yeah, I'd appreciate it if you spoke about the 250 companies that SEBI has identified, what the rationale for that is, and what your expectation is for that.
Correct. So SEBI has identified these companies with no other rationale other than the size of the company. So the top 100 companies, see till October 2017, which SEBI gave this circular, which I think is one of the biggest, most powerful circular for the betterment of the industry, and that's undoubtedly so. All the regulation is equal to the one regulation or the circular which has come to cleanse the mutual fund industry, in which it says large companies were undefined. Somebody would say 10,000 crores, bigger than 10,000 crores is a large company. Somebody would say 5,000 crores is a bigger company. So SEBI said the top 100 companies of India, as per this value of their entire company, which is called market capitalization, will be the large caps of India. The subsequent 150, again as per the size or the market cap as they call it, will become the mid caps of India. From a mutual fund perspective, all the rest of them, which are the other 5,000-6,000, whatever odd, are called the small caps. So even a 30,000 crore company and below, by this definition, is called a small company. Whereas before the circular, a 30,000 crore, 28,000 crore company was called a large company, straight it has gone down to small company. Because they wanted to bring some degree of parity for this English nomenclature, large, mid and small, there was no definition, this was put in. That's the 250 companies. So if money is coming into large cap funds, a fund manager is mandated to put 80% of the money he collects into these 100 companies. So those are, as per size, is the classification.
I'm a tax lawyer by profession and I'm in my early 30s now. So let's look at your plan B with the objective 60 to 70 in the mutual fund and the rest balance in 30 in the structured products. So I'm more on a logic point here. When you look at mutual funds, you know the logic behind. You can, on public domain, you have the data of the past performance. But as regards your structured products, we might not have the data how to correlate that with the past performance. As you said, there are past performance. You have looked into the last 10 years, you have been invested in the structured products. So we want to know how exactly we can track or we can understand the past performance and then take a decision to invest in those structured products.
Wonderful. Yes, that's why when I'm saying that my experience, my comfort would be derived out of my experience of doing that. Of course, a person when he or she is evaluating a structured product, okay, unlike a mutual fund, structured product is not an instrument which has 25 lakh crore, right? Mutual fund industry is a 25 lakh crore industry, right? It has immense amount of transparency and public domain information. Structured product, if I have to draw up the industry shape today, there are about 4-5 players. Anand Rathi is the largest issuer, hopefully, yeah, in terms of at least gross mobilizations on a monthly basis. But I think it's very important for you to interpret a structured product before you put a penny.
Correct.
Because, see, if a product tells me that if Nifty went up by 5% only, and the product can give me 17%, right, that's like 12% additional possible. So I will have to understand the mathematics of it. So we deconstruct. See, after this is a larger gathering, ideally at Anand Rathi, off record, what we do is we discuss one-on-one with each of the people in a closed room session where we discuss strategy, where we take a person through how is it constructed, how is it made, how is it possible that if Nifty goes up in 3.5 years, okay, I'm now saying exactly the product, in 3.5 years Nifty goes up 20%, my product will deliver 75. It sounds like a lacuna, na? Right? 20% growth in Nifty, 75% growth in my product. If this could happen, then why would I want to do something else, is what some clients ask.
Yeah.
So it's important to understand each component which goes into making this, right? And then take the call. In that discussion, you have to look at past performance. Past performance, if I have to give a synopsis, Indian structured product industry started in June 2006 with Merrill Lynch issuing the first structured product in India. Several products have been made, no default, no delay, even for premature is the history. then performance, fortunately, of structured product, even a television can tell you, the ticker on BTVI, if Nifty is this much, I will get this much. So it's so mechanical without a human involvement. So the performance, you have to take it with a pinch of salt. Saying that if it has done well also, you should not be too excited because Nifty did well, right, 20%. So I think if you look at the equity structures of about 100 which have matured recently, 18-19% has been the average return. At least the 100 which we designed and matured. And then you have a ISIN number for every, you can check on the public domain because every product comes with a regulator. No? RBI is the regulator of an NBFC, so you can check in the public domain and you have to vet this.
I'm Subramanian.
Yes, sir.
So I just want to seek some clarification on market-linked insurance policies. Someone takes a decision after 40 to go in for an insurance to see that he secures his retired life. And I wonder whatever the promises that the insurance company makes, they will never be able to deliver it, and I don't think there is any control on that at all. Like, you know, there is a rate of return for all the investments, and we can always go to the net and see that we switch the portfolio, whatever we do. The charges that are involved ultimately eats into the entire return, and ultimately what is left with is 3 or 4%. Can there be any regulator like, you know, beyond 40, mortality charges are going to be quite high and it keeps on increasing, and there is an administration charge, and there is a fund management charge and whatnot, and there is a switch charge as well when you try to manage your portfolio. Can there be any sort of a solution for those guys who are really parking their funds to secure the retirement on market-linked insurance policies?
Thank you for the question, Mr. Subramaniam. I think I very passionately feel of this. That's why we banned it at our place, to club two objectives. That's where objectives, see, if I'm insuring myself, I have to insure myself. If I'm investing, I have to invest. See, like we discussed liquidity risk. It's enormous in an insurance policy, right? If I have to do investing, it has to be mutual fund. If I have to insure myself, only use a term policy. If you bought yourself a ULIP now, 2000, I'll now again give you data, because you can collect so much data of live policy. So we collected 2000 live policies of several customers, which have finished 10 years, substantiating your point, sir. Okay, 10 years have been finished, 2000 policies, 4.6% average return. So what you're saying out of your experience is what data is also saying. And then you getting into something which can be investment and insurance is a complete no-no.
Moreover, it is more to do with the decision for going in for a market-linked insurance to see that when the maturity value comes, it is tax-free. That is one reason that people really look for it, and ultimately what they land up is a post-tax return of something like 4%.
Correct.
Which is somehow
Section 10,
disappointed.
Section 10 helps you bring down your tax on the maturity. In fact, unfortunately, and I represent wealth management industry, but unfortunately, that's why I say so. As soon as equity mutual funds became taxable, people started using this as a USP, unique selling proposition, saying buy an insurance, you will get a tax-free exit. Taxation only has to be the second or third objective when you're investing, and tax can't take the primary requisite to invest. And what happens is, you have a tax-free instrument, but the commissions are like 25, 30, 40%. So it's impossible for a person to make money when one mutual fund kind of a instrument on a yearly basis can give you 1%, and another instrument can give you, I have seen 10 years back commissions of 75% on your first year premium. Then comes IRDA, and rightly so, regulated it, but I think there's a long way to go. And I think SEBI is leading the way in terms of something as recent as Monday, or this Monday, SEBI released a circular saying which brought down the cost of mutual fund investing further.
I just want to thank Feroze for having been a wonderful panelist with me. It's been truly interesting to really talk about the whole, the vision one should have for portfolios. I mean, we've also had a question from someone in the audience who's in their 30s, and they're asking, you know, this is a taxation lawyer, if I got it right? Really talking about how they should be looking at different aspects of that as well. Thank you very much. And I also want to thank this audience for having been excellent in terms of just listening to us. And I do hope that this was an interesting conversation. I must say that as Business Television India, it's been wonderful for us to have this in cohesion with Anand, Rathi in terms of the same kind of invest and prosper goals that we share. And on that note, I'm going to close this.